All right, for more reaction, we're joined now by Bernie McTernan, a senior analyst at Needham. How do you react to this change in the executive suite? And is Mr. Risher, what is the hand Mr. Risher has been dealt to play?
Yeah, no, it's a great question. And I think the important context here is that the company's strategy has already been changing since the beginning of this year. And that's what David was just talking about with you guys on the Fast Money last night, where it's really lowering prices. And, to quote him, you're not in the game if you have lower prices. So we actually run a mobility tracker. And even in January, it said that Uber was cheaper 60% of the time, and they came faster 67% of the time. And that's just, that's tough for the number two operator to be facing against that competition. So since then we've seen Lyft be more competitive, offering things like 10% promotions. But that's the big question here: is can they be promotion and still get to profitability? I think less surge pricing or less prime time pricing is something that's weighing on their 1Q EBITDA guide of only generating $5 to $15 million. So really that question on incremental margins this year, and if we're heading into a price war, I think is the key debate on shares going forward.
Well, that was kind of, as I was watching the interview with Mr. Risher last night, I kept thinking, how does this company compete? You either have to compete on price, that's number one, because they're basically commodity services, and a lot of the same drivers in cars work for both. You got to compete on price, or you got to compete on, as you put out there, timeliness. Do they show up on time? Do they get you where they say where you say you want to go in a timely fashion? And if you can't win on those competitive things, you're just not going to win.
Well, and that's been the bear case on shares, and that's the reason why this is, people have been pointing to this being a value trap. The stock's cheap. But that's one of the things, is that I think the buy side is probably a lot lower than the sell sides at $260 million of EBITDA for 2023. That gets you to roughly a 10 times multiple. I think some of the bears in the stock are significantly lower, so that multiple differential with Uber on those numbers is actually a lot tighter.
Would you touch Lyft here?
We have a neutral rating, and I think that's the risk here, is that the incremental margins for the year are just going to be lower. And so you have a new CEO coming in. It allows you to, maybe reset the decks and really go after market share, because market share has been bleeding. It's, 33% down to 25%. It really needs to stabilize and go higher for, I think, the stock to work for the long term. But the problem is that this isn't 2021 anymore, right? So EBITDA matters, free cash flow matters, and the stock's not going to trade on market share. It's going to trade on EBITDA. So I think that balance is what's so difficult for the stock at this point in time.
Bernie, you're a nice guy. Neutral is a very nice way to put it. Thanks very much. Bernie McTernan, we appreciate it.